Welcome to this explainer. Today, we're jumping straight into the mechanics of market crashes. And more importantly, we're going to build a system to actually protect your wealth. We've all seen those dramatic headlines when the market bleeds red. But what if a crash isn't just a stroke of bad luck? What if it's actually a test, one that you can pass with flying colors if you just set up your defenses ahead of time? By the end of our time together today, you're going to know exactly how to turn a scary market downturn from a complete disaster into one of your absolute greatest wealth-building opportunities. Okay, let's quickly run through our roadmap. We're covering the reality of market crashes, the brutal math of losing money, why missing the best trading days is so costly, our core three-part protection system, and finally, the psychology of panic. Section 1, the reality of market crashes and why downturns are exactly like the changing seasons. Listen, to start things off, we really need to completely rethink how we view market drops. They aren't these rare, freak events targeting you personally, right? It's kind of like winter. You don't need to predict exactly when the first snow is going to fall. You just absolutely need to own a coat before it does. The stats prove that if you invest long enough, you're going to face these drops multiple times. We're talking 10% corrections every year or two. 20% bear markets, expect those every 4 to 6 years. And those severe 30% crashes hit roughly once a decade. We literally just saw this play out in our current 2026 landscape, where the S&P 500 dropped nearly 9% in just a matter of weeks over geopolitical shocks. It's totally normal. It's just part of the cycle. Section 2, the math of losing money and how compounding fails violently. So this brings us to the core issue. What actually happens to your money when a crash hits? Everyone loves talking about compounding when the market is going up, but you know what nobody talks about? Loss asymmetry on the way down. This principle basically proves that compounding wealth doesn't just fail gently during a crash, it fails incredibly fast and violently. When you lose money, the math of just getting back to where you started is heavily stacked against you. Let's say your portfolio drops 40%. A lot of people naturally assume, okay, I just need the market to bounce back 40% and I'm whole again. But you don't. You actually need the market to surge 67% just to get back to the exact dollar amount you had before things went south. That massive gap between the loss and the gain needed to recover, that's exactly why so many folks never fully rebuild their wealth after they panic. And the crucial point here is that this asymmetry gets exponentially worse the further you fall. If you suffer a severe 60% loss, which, by the way, we've absolutely seen in extreme historical crashes, your money requires a massive 150% gain to recover. Your money literally has to more than double just to break even. This highlights exactly why you cannot afford to panic sell and dig that hole any deeper than it already is. Moving on to Section 3, missing the best trading days and the true cost of panic selling. Abandoning the market out of fear is the ultimate psychological trap that makes that steep mathematical hole even worse. When everything is red, pulling your money out feels like safety. But check out this staggering data from a 20-year S&P 500 study. If you invested 10 grand and just stayed put through every terrifying headline, you'd end up with about $64,000. But if you tried to time it, sat out, and missed just the 10 best trading days out of roughly 5,000 total days, it literally cuts your long-term wealth in half to $32,000. Miss the 60 best days, you're left with barely $4,000. Unbelievable, right? And here's the real kicker you should take away from this. The best trading days in market history do not happen during calm, boring periods. They happen during and right after the absolute scariest market crashes. Get this, 7 of the 10 best single-day returns in S&P 500 history happened right in the middle of the 2008 financial crisis. Meaning, panic selling completely locks you out of the recovery. Section 4, the three-part protection system and how to prepare before the drop. Since we know winter is absolutely coming, and we know how punishing the math is if we get caught unprotected, here is the core focus of our explainer, a highly effective three-part protection system. This exact setup shifts you from a panicking investor to a prepared one who actually builds wealth during a downturn. But you've got to set these 3 steps up while things are calm, because once the crash starts, it's already too late. Step 1 acts as insurance for your compounding. You need a real emergency fund. 3 to 6 months of living expenses sitting safely in a liquid, high-yield savings account. Because look, during a crash, layoffs happen and unexpected bills pop up. Having liquid cash ensures a sudden surprise expense won't force you to sell your investments at rock-bottom prices just to keep the lights on. Step 2 is automating your investments, totally ignoring the headlines. This is called dollar cost averaging, and it is a complete game changer. Let's say you invest $200 a month. Month 1, shares are $20, so you get 10 shares. Month 2, the market tanks and shares are $10. Well, your automated $200 naturally forces you to buy 20 shares, double the amount exactly when they are cheapest. You don't even have to think about it. By month 3, as the market recovers, you're sitting on way more shares at a lower average cost than if you tried to time it.
Step 3 is diversification. This ensures your money is spread out safely. A really common setup might be a split of 70% stocks and 30% bonds, giving you a nice balance of growth and stability. You never want all your wealth riding on one single bet, because when a crash hits a specific sector, like tech in the early 2000s or financials in '08, it can wipe out decades of compounding in a flash. Now picture this post-crash reality. When stocks fall hard, your portfolio might naturally drift to a mix of, say, 55% stocks and 45% bonds, just because the stocks lost value. Having a diversified portfolio allows you to step in and rebalance. You sell some of those stable bonds that barely moved, and you buy stocks on a massive discount to get back to your 70-30 target. It perfectly forces you to buy low and sell high without relying on emotion. Finally, Section 5, the psychology of panic, and why investors sabotage themselves. Here's the thing. Even with that perfect 3-part system in place, none of it works if you let your ancient caveman instincts take the wheel when the market bleeds red. Behavioral economics legends Daniel Kahneman and Amos Tversky explain this concept called loss aversion. It proves that our brains are literally hardwired to scream at us to stop the bleeding. Losing $1,000 feels twice as painful as gaining $1,000 feels good. That is a fantastic survival instinct for running away from a saber-toothed tiger, but it is a totally lethal instinct for investing. To see exactly how fatal that instinct really is, consider the 2024 Dalbar study. The S&P 500 returned around 25% that year, yet the average stock fund investor only made 16.5%. They had access to the exact same market, but everyday investors vastly underperformed purely because they tried to time their buying and selling based on their own fearful emotions. And hey, this doesn't just happen to rookies. Even Wall Street legends couldn't save people from themselves. Take Peter Lynch. His famous Magellan Fund made an incredible 29% annually on average. Yet somehow, countless investors in that very same fund actually lost money. Why? Because they panicked when times got tough, sold at the bottom, and only bought back in when the hype peaked. The strategy was perfect, but their behavior was destructive. So, because we know for a fact that crashes are guaranteed to return, your absolute most important task today is to set up this 3-part system in advance. Protect your foundation with an emergency fund, automate your investments, and diversify so you can rebalance. If you do this while the market is calm, you can simply step back, let the math do the heavy lifting for you, and quietly pull ahead while everyone else runs for the exits. Look at your portfolio today and ask yourself, when the next crash inevitably hits, will you be the investor who panics or the one who quietly pulls ahead? Thanks for joining me on this explainer, and keep compounding.